everyone. Thank you very much for joining us today. My name is Patrick Ray. I am one of the ExxonMobil retirement advisors here with the retirement group, and we appreciate your attention this afternoon. And before we get into today's material, I've got a couple of things to cover and share with you. First and foremost, we are not affiliated in any way with ExxonMobil, nor are we affiliated with Voya. And as it turns out, our experience comes with over 30 years of practice in helping folks who are in similar positions as yours and trying to help them achieve and maintain a successful retirement. And one of the avenues we do to educate our folks is through this webinar platform where we bring current affairs and things that are certainly the most common questions that we get on a regular basis to help you prepare for one of the most important financial decisions that you'll ever have to make. And so we also do have other resources that are unbelievably valuable. If you have some time, you'll see some links into the chat to peruse our ebooks library, which has a bunch of short to read, very timely topics and questions that we get on a regular basis, as well as one of the most valuable things you'll be able to get is if you want to spend some time with us, we're delighted to do something called a cash flow analysis with you, which is kind of a stress test, if you will, of your overall financial plans and to ensure that you're on track to meet your overall goals and your overall financial objectives to ensure that you have a happy and successful retirement. And so because of that, these webinar platforms and all the education that we bring to the table are one of many tools that we feel are certainly prudent and helpful in the event that you're open and interested in getting some help or looking for a partner in retirement. Last but not least, if you have questions about either today's material or anything that might be on the topics that are important to you, please feel free to type your questions into the question and answer box, and we'll do our very best to get to those towards the end of the material today. So without further ado, I will bring on today's speaker, Tyson, and my partner to talk about today's material. Tyson?
Yes, thank you, Patrick. Thank you, folks, for attending our webinar series this afternoon. My name is Tyson Mavar, one of the ExxonMobil focused retirement advisors for the retirement group here in Texas. And it's been a pretty tumultuous year for our clients, for maybe many of you, with the markets having done what they've done throughout. Here we are in May. The popular indices such as the S&P 500, which they call the equity units in your Voya, your 401k plan, as well as the Russell 2000 and the International Index, which are also represented by a couple of the index funds in your 401k plans available through ExxonMobil, have not performed well this year, especially in this last month. And this is oftentimes when our clients and the people that we work with at ExxonMobil look to us to bring some sanity to the decision-making process when it comes to their retirement dates, their pension options, their investment allocations in the 401k plan, as well as the investment strategy that they intend on employing after they leave the company and need to produce cash flow once their paycheck stops from ExxonMobil. So today we're going to talk about some of these issues, some of the things that we believe you ought to consider as somebody approaching retirement from ExxonMobil or somebody who may have recently retired from ExxonMobil. We're going to talk a little bit about the interest rate implications on the lump sum. We're going to talk about our philosophy at the retirement group on producing cash flow in retirement and minimizing the probability of permanent loss of capital in your retirement plan. So many of you may have met with us in the past. You may be clients of ours already. May have come to some of our seminars or in recent years, these webinar series that we've done to communicate important issues to the people that we care about at ExxonMobil. We're an independent advisory company that manages retirement assets for ExxonMobil employees and a variety of different corporate employees throughout the country. We hope that you will take advantage of some of the complimentary services that we have to offer anybody that works for ExxonMobil, regardless of whether or not you're a client, in hopes that you might consider becoming a client, or you might at least maybe have some nice things to say about us to your coworkers before leaving the company, retiring from ExxonMobil. If you're not following us on LinkedIn, I highly encourage it. That's where we will record these webinar live presentations that we do, and you can review and peruse different topics at your own leisure, whatever might be of interest to you or relevant to your specific situation. And like Patrick mentioned, we have this cash flow analysis. Many people have told me that it's very helpful in understanding where they stand and also helping them to understand some of the risks going forward and how to avoid some of those potential problems in their retirement plan. Please take us up on it if you haven't already, or if it's been over a year since we've updated yours. I encourage you to have us update that as well. So today we're going to talk about what's happened in the recent past to lead us to where we are today, where we may be going, and as a result, what we think you ought to consider as a result of your retirement strategy, whether or not you've left ExxonMobil already. So many of you know we've seen unprecedented levels of government spending as a result, in part, to get through a pandemic. And some of the implications that have come with that being what we haven't seen quite yet are higher tax rates, but we anticipate seeing this, and could be a very big risk and detriment to a retirement plan, especially one for many of the people that we work with at ExxonMobil who have a majority of their life savings in pre-tax buckets, in accounts that will be taxed at some unknown future rate. We've already seen the hidden tax known as inflation, some of the highest levels in over 40 years, which was a result of both higher government spending and monetary policy measures that were aimed at stimulating the economy, but ultimately have their long-term detriments of devaluing the currency and making our cost of living a lot higher. We've already seen that recently. We anticipate to continue to see that going forward, which has, of course, its own risks on a retirement plan. And what has stemmed from that is higher interest rates, which have a whole host of implications. Many of you realize the implications on your pension lump sum. We'll talk about that in a moment. Implications on your bond holdings, whether it's in the bond units in your 401k plan, maybe bond mutual funds, or even individual bonds you may own outside of your 401k plan, and any fixed income investments, as well as the rate at which we can borrow money, whether it's for our home, for building a business, for whatever consumer purchases we may be looking at in retirement. It affects all of us in different ways. And unfortunately, this has its detriments on a retirement plan, but fortunately, there are some opportunities that we want to discuss today to put a silver lining on this somewhat dark cloud that we've seen hovering over us for the last couple of years. Now, many of you may be familiar with the interest rate impact on your lump sum. As interest rates go up, the ExxonMobil pension lump sum will go down. Whether you're planning on taking a full or partial lump sum on your pension, this is a big risk going forward for anybody who cannot retire by the end of May, which for most of you who are not grandfathered, you would need to do to have a June 1st benefit commencement date and therefore lock in the second quarter interest rate, which was very favorable and unfortunately is going up quite a bit in the third quarter. So let's take a look at what these rates have done. On the top here, you can see what March and February interest rates that were published in late April, at least the March rates were, that averaged to these quarter 3 2022 blended interest rates for non-grandfathered employees. You can see there's 3 different rates we follow. They're corporate bond interest rates that are based on short, intermediate, and long-term corporate bonds. The most important of which is the second segment rate, carries the most weight on the calculation. For example, it's 3 times more relevant than the first segment rate. So this is the one that we follow the closest. And you can see the quarter 3 rate is 3.53. Compare that to the quarter 2 interest rate for anybody who commences their benefit in the second quarter was only 2.72%, which is an increase of 79 basis points or 0.79%. Now, what does that mean in English? Well, the rule of thumb that we follow, and this is a function of your actual age, but when interest rates go up 1%, you can expect close to a 10% drop in your lump sum. Now, they didn't go up quite 1% from second quarter to third quarter, but it wasn't too far off. And this may be more of a disadvantage to you if you're younger. If you're only 55, it might be closer to 12% drop in your lump sum for every 1% increase to the rates. So we saw clients in many cases losing tens of thousands of dollars overnight if they work into the third quarter, or for non-grandfathered employees, you can't even work into June to still maintain a second quarter interest rate and commencement date. And it could mean over $100,000 lost, in which case you may be working for free for the next 1 to 2 quarters, depending on your salary, your years of service with the company, and some other factors. Now, this is for most employees, this non-grandfathered corporate bond interest rate schedule we see here. But on the right, you can see there's grandfathered rates, and there still are some employees that meet the criteria for being grandfathered. And those interest rates are going up only 0.5%, which is still pretty detrimental from a quarter to quarter basis It might mean 4, 5, or 6% drop in your lump sum going into the third quarter. So it's probably too late now to be making a knee-jerk decision on retiring in the next 13 days effectively. Some of you on the call may have already put in your smart form and your commencement package, may have ordered it at least. And this is something we help our clients with to make sure that they get the paperwork filled out correctly, that their benefits coordinator is giving them good advice on their timing, the implications of taking a lump sum versus annuity. There's a lot of decisions and moving parts on this decision on how to take your pension, as well as the timing of your retirement. And this is what we're here to help our clients with before retirement. And then, of course, if you decide to choose us as your financial advisor, then we have a whole other conversation to have about investments, cash flow, tax and distribution strategies, and so forth. So we focus a lot on this. It's a quarterly change in the rates, and therefore a quarter by quarter decision to retire and commence your benefit, which the two may not coincide with one another. But this is what we focus a lot on as advisors that specialize in the ExxonMobil retirement benefits. Now, we talked a little bit about government spending, low interest rates, and the long-term detriments of both of these. But we also want to talk a little bit about our investment philosophy. How do we protect our wealth in retirement when we may have higher taxes in the future and our purchasing power is declining or may be declining at a faster rate than we've seen in over 40 years? Well, at the Retirement Group, we believe in investing in good assets, good investments, but only at a good price. And it's a philosophy of value. This philosophy entails buying solid companies at or below their intrinsic value. And this is harder in the environment that we're in. Now, of course, we've seen some expensive companies come back down to earth in terms of their price, and many of them still have a ways to go. But our goal is to avoid expensive mistakes, to avoid overpaying for an investment, especially because it might be popular. That's typically when an investment is overpriced, is because the market or other investors have bid up the price because of its popularity. We like to look at the fundamentals of a business. So we like to look at the earnings of the company, the balance sheet of the company, the revenue and expenses of the company, the debt of the company. And we look at all these fundamentals, but then we compare those fundamentals to the price that we're paying for a share of stock. And we may love the fundamentals of a company, but because everybody else loves those fundamentals, the price is too high for us to want to pay for a share of stock, and we would put that in the no pile. We wouldn't invest in that company in a retirement portfolio. We like investments that have high dividend yield in a retirement portfolio, especially in a low interest rate environment, but it's not necessarily the absolute objective of ours in looking for investments. We have, in fact, one of my favorite long-term stocks, not in every case, but Berkshire Hathaway hasn't paid a dividend in close to 60 years, and it's had phenomenal performance. And there's other companies that are paying dividends that they cannot afford to pay, and they're stealing from shareholder value by paying and potentially taking on debt to finance these dividends. So a high dividend yield could be good, but it's not necessarily a requirement or a prerequisite for a value investment. And we'll identify great money managers. So money managers that have a good track record. In fact, we have 8 tenets of a successful and solid money manager that we recommend to our clients. And some of those tenets entail eating their own cooking, having a large portion of their own net worth invested in their own company or their own fund, low expense ratios, good fundamentals, like we talked about some of the ratios earlier, and a variety of different tenets. If you'd like to read that white paper, I encourage you to email us or call us and we can send it out to you. And our number one objective as value investors is to not lose money. Rule number 1, don't lose money. Rule number 2, see rule number 1. Our objective long-term is to avoid permanent loss of capital. Now, volatility can contribute to permanent loss of capital if you were too aggressive in your portfolio and couldn't weather a storm, if you didn't have enough conservative money to avoid selling your stocks for the period of time that they are irrationally low priced, which we see in many cases during a recession or a correction. Another contributor to a higher probability of permanent loss of capital is our emotions and being too aggressive for our risk appetite or our risk tolerance. if we find ourselves, and I've had many conversations with our clients just in this last month that feel the urge to need to do something whenever markets drop or whenever one particular investment drops, the first thing that comes to mind or consideration is let's consider selling this investment, when in reality, not always, but on average, we prefer to do the opposite of a good investment rather than sell it after it went down in price. We may want to consider buying more if nothing has fundamentally changed about the quality of that investment. So this is our philosophy at the Retirement Group, and we preach this to our clients and try to educate them so that when times get tough, we can always go back to our conviction in our long-term philosophy that historically has allowed people to have satisfactory results on their investments and get through tough times of higher taxes and higher inflation. We have a chart here I wanted to pull up where we compare in purple the long-term value index. And this goes back, you might not be able to see, but it goes back to about 2002, which many of you know that was about the bottom of the market after the tech bubble burst. And it goes all the way up to not quite today, but 2020. And you can see the explosion of the blue line, which represents growth investments or the growth index, explosion in the price of stocks, primarily in technology stocks, very popular stocks going into the pandemic, the stay-at-home stocks. This happens from time to time. This happened in the late 90s where there was a massive dispersion from value investments and growth investments, where expensive stocks get more and more expensive as a result of their popularity. And the higher price they get, the more popular they get and continue to go up at an exponential rate. Now, you can make money on growth stocks in this momentum-driven environment, but there's a lot of risk. And unfortunately, we never know the time when the tides will change or when there's going to be sector rotation, as we call it. And although value investments on average outperform growth investments historically, these are the types of times that we really want to focus on value, is when there's companies out there that are still trading at reasonable multiples to their earnings or to different metrics that we look at. This shows you going back to just 1984, but this would stay consistent even if we went back to the 1920s, where you can see there's rotations. In green, we have value outperforming growth, and in purple, we have growth outperforming in value. It almost looks like a tide chart. And so you can see we've been in a very long environment of growth outperforming value. This only goes up to 2019, but it would continue on. But within the last year, we've seen this tide start to turn. And what we've also found is that historically, value investments are a much better hedge against inflation than growth stocks, and for a variety of reasons, but one of which is because the debt that growth stocks have and the valuations being based on future cash flows as opposed to current cash flows, which many value stocks have. Now, we relate investing in stocks to owning a business or purchasing a business. This might be something that you consider in your retirement plan with a portion of your assets, hopefully not all of your retirement assets, because it can be a risky venture, especially when there really are no do-overs in your retirement plan. But let's, for example, take a flower delivery business. The cost to buy the business, $200,000. The book value, which is assets minus liabilities, the book value of the company. This particular company has no debt. And its assets are 5 delivery trucks worth $160,000, inventory or flowers in this case worth $10,000, giving it a book value of $170,000 because the fact they have no debt. So of course we would like this as a value investor, the fact that there's no debt, but that doesn't mean debt is necessarily bad, especially if you can leverage that debt in a safe environment to produce better future cash flow for the business. This company is netting $30,000 a year of income. Net, which is revenue minus expenses, net profits or earnings. And the owner decides to keep $24,000, which every business has that decision to make. How much are we going to keep, retain earnings? And we could pay that out as a dividend, or we could maybe buy back shares of our stock if we think they're undervalued or low priced or a good bargain. And those are things that we look at when we're valuing stocks. Of course, this is a simple example and it's a lot more difficult to find a valuation for a complex company like ExxonMobil, for instance, or like any Fortune 500 company. But this is why it pays to have a very good capital allocator, a smart money manager that not only has a good track record, but sticks to his or her principles when it comes to buying a company or buying a stock. Now, like we talked about, we've seen unprecedentedly high levels of government spending in the last more than a decade, but certainly in the last 2 years. Now, we can't get something for nothing, and we are going to have to pay for this somehow, and probably in 2 different ways. By monetizing this debt, and we've seen this through the inflation, the hidden tax, like I mentioned earlier, and by either cutting government spending and probably both, cutting government spending and increasing taxes over time. This becomes a big risk to retirees who haven't paid taxes yet on their retirement savings, which is your pension plan, with the exception of if you have a non-qualified or supplemental pension plan, that gets taxed right when you leave the company for any of you high earners. The rest of the money that is allowed to be deferred, most of your pension and probably most of your 401k as well, we have this uncertain tax rate. And this is something that concerns us, but that we work with our clients on tax and distribution strategies to minimize not just this year's taxes, but our lifetime tax bill, even if it means potentially paying a little bit more taxes now while we enjoy a relatively or historically low tax regime. Now, how do we take advantage and what opportunities actually exist as a result of the environment that we're in today? Well, when it comes to value investing, we're trying to take advantage of price volatilities, and we've seen high volatility this year in 2022. Volatility being the fluctuations in the price and in some cases the value of an asset or an investment. And oftentimes volatility is not necessarily rational compared to the actual valuation of a company. In other words, a company's stock price might go up 100%, even if its value only went up 30%. We would probably want to avoid that. It would be an expensive investment. And on the other hand, a company's valuation, because of some bad news, might drop by 50%, when in reality, its true valuation may have only dropped by 20%. And we may consider that a bargain. We'd have to look at it in greater detail, but we want to take advantage of the emotions of the market, which create bargains and avoid some of the biggest mistakes that result from greed in the market, which we've definitely seen a lot of in the last couple of years. We don't want to get caught up in the herd. This is even more prevalent today in a society that's driven by media, whether it's television, social media, internet media, all of this information that's constantly coming at us, oftentimes not relevant and oftentimes designed to get a rise out of us or create emotions when otherwise emotions aren't necessarily warranted. This creates problems with investment strategies because we may panic when there's no need to and sell investments for less than they're truly worth, or we may get too excited about an investment opportunity that may be overpriced and may not be a good long-term investment, especially for a retirement portfolio. We also want to find managers that not only have the ability to hold cash, which many mutual funds and index funds do not. For example, your units, the various index funds in your 401k plan, those are fully invested. The S&P 500, for example, in your equity units, that's fully invested in the largest 500 companies in the US. And furthermore, it actually overweights the bigger companies based on market valuation. So when one of those companies' stock prices goes up more relative to the other companies, that S&P 500 or your equity unit is going to invest more in that company. When in a lot of cases, we prefer to do the opposite. We would prefer to buy more of a company that might be on sale after its stock price has gone down rather than after it's gone up. So finding managers that hold cash, have the ability to, and also have a track record of doing so when times are warranted is something that we also recommend, even though unfortunately there will be a headwind on that cash position, especially in an inflationary environment like we're in today. You're not only not going to be earning interest on that money or much interest, you're also going to be losing purchasing power to inflation over time. However, in a retirement portfolio, when you don't have a paycheck, or maybe you have Social Security, maybe a partial pension, maybe your spouse still works, there could be some other cash flow streams. We want to make sure we have other areas to pull from when inevitably our stocks are down in price so that we don't have to sell them. And this is what retirement portfolio allocation comes down to, which is all we focus on as a retirement group and what we hope that you and your advisor focus on, whoever that might be, after you leave ExxonMobil. What unfortunately is uncomfortable today may be a great opportunity. Because of how our brain is wired, it drives us away from oftentimes great opportunities. And potentially to decrease risk, we need to find investments that are on sale. And unfortunately, that's not always comfortable because it might be contrarian to popular belief at the time. And these items are going to cause discomfort when the portfolio value falls, or when an individual investment value falls. But sometimes short-term discomfort is necessary to long-term success in a retirement portfolio. And we think this is vital to stick to the long term. That's in part what our job is to our clients, is to be a sounding board for their emotions, for their concerns, to give them a pep talk from time to time, to keep them out of trouble from diverting from the long-term plan, which is aimed at, number one, not losing money, keeping up with inflation, managing an efficient distribution strategy to minimize taxes and never overpay in taxes, and ultimately to not run out of money and hopefully have some left over if there's some people or causes that are important to you to leave those assets to. History has shown that the best time to retire is when stocks are on sale. Now, there is still, even with this downturn in the market, a lot of stocks that are way overpriced that we'd like to avoid. But just because the market as a whole may still be overpriced doesn't mean that we can't find good bargains and good value in the market. Unfortunately, you can't do that if you index. If you just buy the whole market, you're not going to be able to select the solid companies that are on sale and deselect the companies that are expensive, overpriced, and may not be even earning any profits for their investors. Inflation becomes a risk. And as it turns out today, dividends are paying more than bonds. Even with the increase in interest rates that we've seen here in 2022, we still need, in many cases, to have stocks in a portfolio, which we also have other risks in a rising interest rate environment. As many of you know, not only does your pension lump sum fall, but your bond prices are going to drop as well. And the longer duration of those bonds, the more sensitivity they have to interest rate increases, which becomes potentially a risk for the rest of your retirement if interest rates continue to climb over the next 30 years like they fell over the previous 40 years. This is a massive risk, especially for asset that was supposed to be the conservative portion of your portfolio. So we may need to look at some alternatives for that portion of the portfolio. And just manage the emotions. This is good to have not just one advisor, maybe multiple, whether it's financial advisors or resources, people that you trust that you could talk to about this to keep you sane. Verify your thinking, because we're all human and we are prone to make decisions that aren't always in our long-term best interest because of how our brain is wired. So it's good to talk through some of these ideas, to look at history. History doesn't repeat itself, but it rhymes, I think Mark Twain said. And we need to look at the past to help us find some clarity about the current environment that we're in and potentially where we're going in the future. Unfortunately, most people, because it's not fun or it's not comfortable to think about, don't plan for their retirement or spend nearly enough time planning for their retirement. They say 74% of Americans over the age of 50 don't even have a written plan for their retirement. There's no excuse to this, folks. We'll do this for you complimentary, no cost, because we want to develop a relationship with you, give you an idea of how we operate so that you might consider doing some business with us after you retire if it's a good fit. And you probably ought to speak to a couple of different groups, because there's hundreds of advisors out there that would love to earn your business, but many of them are probably not qualified to earn your business. So looking at the things that we found are important to people, having a track record working with ExxonMobil employees so that they can verify they're not going to make any mistakes when they leave, having a long track record of working with clients that are in the retiree space so you can have confidence that they're not going to let you make any mistakes. understanding the differences in the costs of the service, the value proposition of that company, what they're actually going to do for you, how often they can talk to you and spend time with you, which we found is the main reason somebody leaves their advisor in retirement, is a lack of communication. These are all things you probably want to start doing research on well before your retirement and not wait till the last minute like many people unfortunately do and make an irrevocable mistake as a result in many cases. Get a second opinion. Here's some of the things we've talked about, but our clients have told us are important. Is your advisor going to help you with the distribution strategy? Not all financial advisors do. And this is figuring out what accounts to pull from, how to be tax efficient, what assets to sell and when, so that you're not having too high of a tax bracket in any given year. Looking at the long-term plan rather than just this year, which is what a typical CPA or tax person will help you with, whereas we're looking at the whole picture, the rest of your life. Understanding the philosophy that we've talked a little bit about today, value investing, and having a more detailed conversation of how that fits into your plan, as everybody's different, as you may know, in terms of risk tolerance, time horizon, cash flow needs, predispositions for or against different investments. These are conversations that you ought to have before entrusting somebody to help you manage your life savings, we at least agree. And some of the other decisions, whether it's Social Security, your health insurance and healthcare costs and decisions in retirement. Estate planning is a pretty important one for many of our ExxonMobil employees that probably won't even be able to spend their money throughout retirement. These are some things you may be interested in. If you're not, then good. But if you are, you want to make sure that whoever you work with has the capacity to help you in these areas. And then, like we talked about, that retirement cash flow analysis, it's a complimentary financial plan we offer. Most advisors offer them complimentary. There's no reason to pay for one of these because of how many advisory groups would love to earn your business. But it's also a good exercise to go through, not just to see where you stand, but also seeing how that communication is and seeing if it's a good fit for whoever that individual is or whoever that company is that you might do some business with when you retire. Do that now before you retire with several different groups. And we might not be the best fit for you, but we think we have a pretty good track record and argument why you might consider us. If you'd like to talk to myself, Patrick, or any number of our ExxonMobil focused advisors of the retirement group, you can call us at 800-900-5867. You can email us at info@theretirementgroup.com. This QR code here on the left, you can take a picture of with your smartphone and get onto one of our calendars, even if it's just for a 10-minute chat. If you have some specific questions, if you have a need for a cash flow analysis or an NUA analysis, whatever it might be. Typically, we've been doing a lot of web meetings. A lot of people have been comfortable with that, but I go to the campus periodically and meet with people in their own homes if they're here in Texas. But just let us know how we can help. We're here to help folks. And also I encourage you to follow us on LinkedIn if you're not doing so already, because that's where we publish a lot of this content related to the different ExxonMobil retirement strategies. I said a mouthful today. I think I might wrap it up now. And certainly if we have any questions, Patrick, I think we have time for one or two. But appreciate everybody joining today's call and hope to talk to you all very soon.
Yeah, great stuff, Tyson. As you know, this is a pretty lengthy topic just because of all the data we push in here. So first and foremost, folks, if you feel overwhelmed about all the material that we covered today, feel free to reach out to us and we'll do our best to break it down on what may or may not apply to you specifically. But we do have some questions, so let's get through these to the best of our abilities. First question, can I roll over a portion of my Voya savings account to a 401k or an account outside of ExxonMobil?
Depends. And what it depends on, you can roll it out to an account outside of ExxonMobil, but whether or not the new 401k administrator, let's say you leave ExxonMobil and go to work for one of the other companies that we work with, Chevron, who uses Fidelity instead of Voya. It's going to depend on the company, how they wrote the summary plan description, if they're going to accept assets from an outside 401k plan. In my experience, usually they do. And what you would want to think about before you do that is, what are the investment options in that plan? Because the ability for that money to continue to grow and pay interest is a function of which investment options they'll allow you to invest in. And as many of you know, 401k plans are notoriously limited on their investment menus. This is the main reason a lot of people will roll their 401k over to an IRA after they leave the company, because then you have the ability to do so. So what makes sense for you will be a function of a couple of those issues, and we're happy to talk to you about your options on that if you'd like.
Here's another question. What are investment option ideas and things to consider if I take the lump sum and leave ExxonMobil?
There are a lot of things to consider related to your age. You may not want to roll over your 401k if you're under 59 and a half because of the ability to produce penalty-free income as long as you left after the age of 55. You might want to consider your cash flow needs. Which way you take your pension is going to also be a function of how you invest the money. So you can see a lot of moving parts here, and everybody's situation is different. Even though you all work for the same company, we could have completely different recommendations from one person to another. And that's why that one-on-one conversation is so essential.
Yeah, I would also encourage this person, if they hadn't already done so, through the links that were dropped into chat, to watch our value presentation, which talks about some ideas if you're looking for specific investment related stuff to consider, to piggyback off of some of the things we talked about today. Another question that's kind of piggybacking off of the question that was just asked: can I roll my lump sum into my Exxon 401k if I retire? And if I do that, why I would consider doing so?
Hey, great question. The answer is yes. You absolutely can move your lump sum pension into your 401k plan at Voya. The reasons I've recommended people do that is, like we talked about earlier, if you're not yet 59 and a half and may need some income from your retirement accounts prior to 59 and a half, and assuming that you worked at least until 55, you'll qualify for a special provision in the tax code called post 55 distributions. For a lot of people, it wouldn't be necessary because you probably, with most people I talk to, have enough money in the 401k to bridge you from age 55 to age 59 and a half anyway. For those of you that might not have the opportunity to save as much in that 401k, that would absolutely be a consideration to pad that 401k to make sure you have enough to get you through that 4.5 or less year period. Another reason people, in my experience, do that is because they love the low expenses of the index funds in the 401k plan. And if you're comfortable managing, there's not that many choices. It's easier for even a novice investor. The reason that they give you those options is because you can't get in that much trouble. Of course, trying to time the market might get you in trouble. And for some of the reasons we talked about earlier, why we focus on value investments, because a lot of those index funds are overweighted to expensive companies. We would not recommend having all your money in index funds, which is all you can do in your 401k plan. You also don't have a lot of safe money options. We talked about the issues with bonds, and that bond fund has certainly got hit this year. Common assets is a pretty good safe option within your 401k plan, I will say, but you only have one. And in an IRA or an outside account, you have more flexibility to diversify even your safe assets, which is another reason people typically overweight moving that money to an IRA versus the 401k. But you can also do both. You could move part of your pension to the 401k and part to an IRA. You have a lot of flexibility with that, but those are the considerations that I've talked with people and heard from people what were important to them in making that decision.
Here's another question. This is correlated to interest rates, and with interest rates going up, how does that affect the stocks in the ExxonMobil 401k? And is there one better to use than another?
There's a lot of implications of rising interest rates for the ExxonMobil stock, which is an option in the 401k, as well as the index funds inside the 401k. We talked a little bit about this in our value presentation, whereas value stocks typically don't get hurt by a rising interest rate environment as much as growth stocks. The reason, again, that is because growth stocks valuation is based on profits that we expect way out in the future in many cases, whereas value stock probably has current earnings, or in most cases at least has current earnings. And when interest rates go up, we have to discount those predicted future cash flows at a higher rate, which immediately or very quickly reduces the stock price, or at least our expectation of a value of a growth stock. So rising interest rates typically hurt growth stocks more than value stocks. And like we talked about, the index funds are overweighted to growth stocks right now. because of what we've seen in this momentum-driven market in the last couple of years. And that was something that we would like to avoid as value investors, and which is what we are here at the Retirement Group.
Yeah, and this question that's next is really a reflection of what you just mentioned, Tyson, with respect to what the expectations are for growth stocks versus value stocks and how they're discounted at current valuations for value purposes and for expected growth or earnings in the future for growth purposes. Mm-hmm. So we'll get to the last question, which is, I've read that oil stocks do well in a higher inflationary environment. Should I just keep putting money in my ExxonMobil stock?
Well, not always. A lot of times inflationary environments are correlated with rising interest rate environments like we've seen now. And in rising interest rate environments, there's typically a short-term negative impact on the stock market because capital flows from the stock market to fixed income investments in many cases, because now fixed income investments are a little bit more favorable, paying more interest. So typically rising interest rates hurt the stock market in the short run, but are typically good for the long-term economy. And what we talked about, rising interest rate environments, which are correlated with inflationary environments, hurt growth stocks more than value stocks. And so this is why we really need to look under the hood on our retirement portfolio and understand what we own and the implications of inflation, rising interest rates, higher taxes on our investments and our ability to preserve our capital in retirement.
Yeah, and to piggyback off of that, if you hadn't had a better reason to understand the tolerance for risk that you're willing to accept with your investment goals and objectives and correlate that to how your money is invested, today would be an impeccable time to do so, just simply because of the historic volatility that we've seen here in the most recent few months of this particular tax year. So having said that, we've been with you for quite some time this afternoon, so we appreciate your attention. Thank you very much for your time. We hope you found some value in spending some time with us this afternoon. And until next time, we'll see you later. Have a great day, folks.
Thank you, folks.